So in terms of a strategy itself, and the strategy, we call it cash flow on demand. That's a way of managing risk. There are 2 or 3 other ways that we do more proactively. We can insure our shares. I'll talk about that in a moment. We can use things like stop losses, which is, in case of emergency, break glass, get out. So there are things that you can do on that side. But the most important one in the first instance is to get educated very, very specifically on that. And it's not something you're going to glean from YouTube. Sure, you're going to pick up bits and pieces, but going to YouTube to learn stuff, even though there's some brilliant content there, is kind of like trying to do a home renovation. You might want to do the plumbing. You get into Bunnings and buy all the gear to do it, only to discover that you're trying to connect metric stuff to imperial, and it doesn't work because it's disjointed. And in the same way, you need something that's going to seamlessly run through everything that you need to in this. So certainly get educated to de-risk this in the first instance. As an advocate for financial literacy, as you are too, educating people on what they're doing with their money has never been more important. So get educated, get control, and see what you can do for yourself, because heck, you work hard for your money, get it working hard for you, and trust yourself over anybody else in that journey.
Welcome to the Get Invested podcast, where we share great conversations with experts from all walks of life to uncover their secret know-how and where they invest their time, their skills, and their money, and the benefits that this has created. You see, the truth is that everyone invests. Every minute of every day, we're investing our time, our skills, our energy, and our money in something. Some of us are investing consciously, some unconsciously, sometimes for good, sometimes for bad, and sometimes for no impact. Get Invested will help you to start living by design, not by default. I'm going to help you to make it happen, not let it happen. You will hear the top tips on how you can live with conscious intent so that you can live more, work less, and leave a living legacy by investing now. Listen to the show to discover the top tips on how to get started, make the most of your investment journey, and ultimately to be living your dream, not someone else's. More episodes can be found on iTunes or at bushymartin.com.au/get invested. Thanks for listening, and now let's get invested. Hi, freedom fighters. Who do you turn to in times of uncertainty looking for confidence in the future? And when you invest, whose predictions and forecasts do you listen to? Your family, your neighbour, your mates at work or down at the pub? Maybe a Facebook group? Or your accountant, a stockbroker or financial planner? Before we answer these questions, let me start with a very amusing story that I've borrowed from Raman Akisa of Pension Craft, that's taken from a thread by Robin Wigglesworth about a Norwegian TV program that decided to test the relative performance of professional share advisors. The experiment was set out to investigate just how much benefit there was in expert investing advice. Managers of stock-picking funds often say that they're contrarian, which means that they do their own research, make their own decisions, and don't follow the herd. This is one reason they think that they're entitled to charge high fees. So to put this to the test, the Norwegian TV show cleverly pits some professional stock pickers against an astrologist, some beauty bloggers, and a group of 5 dairy cows shitting in a field. And what have cows pooing in the pasture got to do with selecting shares? Well, you'd expect nothing. And this is exactly the point. And the results are very interesting. The cows selected their daily share stocks by pooing on a grid that covered the entire field, with each square representing a different company share. The 2 stockbrokers were confident that they were going to do well, arguing that the more you know, the better you will do. The astrologer made his selections based around the fact that it was the year of the goat in the Chinese calendar, while the beauty bloggers said they didn't recognise any of the company names on the list. So they picked based on how well they liked the sound of the company name. Now, all of their investments were held for 3 months and then sold off to see who had brought in the biggest return on their investment. So who do you think outperformed in picking shares over this 3-month period? Well, the astrologist came bottom, and in fact he underperformed the whole Norwegian stock market. The professional investors drew neck and neck with the random crapping cows including their star bovine fund manager named Gulros. But the people who did the best were the beauty bloggers. And this is not the only example of random animals outperforming professional investment advisors. In 2010, a Russian chimpanzee named Lusha outperformed 94% of the stock analysts in the country over a 3-year period. Lusha made her picks after, and excuse a very bad pun, after monkeying around with a group of toy cubes with different company names on them. Now, contests like these have been done before. The economist Burton Malkiel argued in his 1973 book, A Random Walk Down Wall Street, that a blindfolded monkey throwing darts at a newspaper's financial pages could do as well as the experts. Since then, people have tested that theory with actual monkeys, cats, dogs, rats, and even a Swedish houseplant. So it appears that bovine bowels and cowpat capital can literally dump on the performance of professional investment advisors and stock-picking share brokers. Now, the Norwegian experiment was a fun gimmick with a short time period that lent itself to quite quirky results. And it further evidences debate that was ignited by Princeton economist in that Burton Malkiel book, A Random Walk Down Wall Street, where he claimed that, again, a blindfolded monkey throwing darts at a newspaper's financial pages could select a portfolio that would do just as well as one carefully selected by experts. And Malkiel's theory was not that blindfolded monkeys are as skilled as experts, but that stocks tend to behave randomly, especially in the short term. And it also highlights a broader point. Most investors should forget about trying to beat the market. And it doesn't appear that the lesson here is that you don't follow the herd, at least not this cow-crapping one anyway. The lesson is that investing is hard. So difficult, in fact, that even highly trained professionals who have dedicated their lives to mastering markets often fail and perform below the market benchmark. The purpose of exercises like this is to show that markets are difficult to beat. And it's often hard to determine whether those that do manage it owe it to skill or luck. So how can you stack the odds in your favour? By developing an investment plan and style that matches your personality, risk profile, and most importantly, your time availability. And this leads us to two more important questions. What's the first and best thing to invest in? Well, no prizes for guessing that it's always your education. And secondly, what investment principles do you adopt to guide and measure your investing? So to set the scene with this and get you thinking about this as an appetite whetter to today's great guest conversation, let me share in more detail the personal investment principles and approach that Sonia and I have adopted over the years. Now let me stress at this point that there's no way or best way or one size fits all in terms of a holy grail way to invest. And if anyone says there is, then run for the hills. As I reveal in my book, The Freedom Formula, how you invest and what you invest in is all about time. Time is all important when investing, and time is critical in the three key areas. Firstly, the time horizon that you're investing for. Secondly, the time that an investment takes to manage. And lastly, and most importantly, I think, the time you actually have available to manage the investment, because this is the ingredient that's most overlooked and misunderstood and is likely to have the biggest impact on your investment results. Now, there's no point wanting to become an active stock market day trader that takes a minimum of 4 to 6 hours a day to manage if you're a busy, time-poor professional trying to hold down a full-time job on top of your other commitments. So the less time you have available or are interested in devoting to managing your investment, the longer and more passive your investment time horizon needs to be. And if you're like me, where time is your most precious asset, and you want to spend as much of it as possible doing things that are important to you and devoting your energy to your family and friends, then you definitely don't want to create a second job when you invest, because this is a recipe for disaster. I've seen way too many investors come unstuck trying to shoehorn an active trading approach into a busy career. And while we're on the importance of time, one of the key questions that my wife and I constantly hear from potential investors is something along the lines of, how do I use the time I have left to instill the time that I've got available when I have no time to do it? This is why my wife Sonia and I have adopted a safe and affordable capital growth accumulation investment approach where time is by far the most critical determinant of wealth creation. Providing your time horizon is long, over 15 to 20 years, a wise investor can commit without great anxiety to investments that appear to be risky, but that will most likely produce the highest rate of return in the long run. This is due to the forgiving accommodation of market fluctuations over time. As Charles Ellis, the author of Winning the Loser's Game, famously said, time, the length of time investments will be held, is the single most powerful factor in any investment program. And to add a couple of quotes from the investment greats, as the world's most successful long-term investor Warren Buffett so perfectly puts it, wealth is the transfer of money from the impatient to the patient. So in simple terms, as a time-poor professional, and depending on your current net worth, you need to invest in either the highest growth or the highest cash flow vehicles that are the lowest cost, most affordable, safest, simplest, and easiest assets that you're comfortable with. Initial investment value growth that is later converted to cash flow is the key investment concept to grasp here. As a result, I personally favour a mix of investment tactics that progressively transition across the full spectrum of shares and equities, property, bonds, cash, and superannuation over time. And it's why my books Get Invested in the Freedom Formula reveal what I call the income for life capital growth to cash flow curve investment strategy that is best suited to the time poor who need low cost, safe, simple, affordable, and easy investment vehicles. On this basis, what to invest in when can simply be defined as dependent on just two critical interrelated elements. Firstly, how much passive recurring income is enough to sustain your ideal lifestyle, and secondly, the income producing asset level that will generate your lifestyle income. Now, based on this, if your net worth is below the required level to generate your ideal lifestyle income, you need to invest in growth assets. Once your net worth is at or above the level required to generate your passive recurring lifestyle income, you then need to convert your investment portfolio into cash flow income assets. And again, it's all about time. If you're an established time-poor professional who enjoys a high standard of living flowing from your high income, many would consider you to be rich. However, as I've said on many occasions before, there's a big difference between being rich and being wealthy. If you're rich, you probably still have to work to generate the active work income to maintain your current lifestyle. Regardless of whether you're an employee or a business owner, you're still trading your time for money. You're trapped in a pair of golden handcuffs. If you stop working, so does your income, and there goes your lifestyle. You only become wealthy, on the other hand, when you have time on your hands, when you're in a financial position where you have the freedom of choice to do what you want when you want. In this regard, wealth is measured by how long you could survive financially if you had to stop work tomorrow. For many of you, this time is weeks and perhaps months, but rarely years. Now, this definition doesn't focus on the total value of your assets as an absolute measure. Rather, it concentrates on time and your cost of living. It accommodates your specific lifestyle and expenditure needs, which may be different from someone else's. Some people are comfortable existing on 60 grand a year, while others require 300 grand a year to enjoy life, or more. You name the number. So in these terms, free time is the biggest indicator of true wealth. Over the last 35 years of instilling in investment by studying others, doing it ourselves, and helping others build their portfolios, my wife Sonia and I have uncovered a number of timeless principles that are critical to achieving this time freedom by creating a passive income for life. And it's important to note from the outset that as time-poor professionals, we're extremely conservative, risk-averse investors who found that over the last 3 decades that the safest, easiest and most affordable way to generate and replace income by remote control is by adopting a long-term investment approach. But before getting into what I call my Bushy Buffettisms that I outline in my book, The Freedom Formula, let me stress that nothing I talk about on Get Invested is intended nor can be construed as financial advice or recommendations. They're purely my own thoughts gleaned from my experience, and I strongly suggest that you seek independent professional financial advice based on your needs, your risk appetite, and your situation before investing. So here's my Bushy Buffettisms. In line with our very patient, long-term conservative investment approach, we've adopted many of Warren Buffett's investment philosophies. Now, Warren Buffett is often referred, as I've said, as one of the world's greatest investors and wealth creators. And his investment approach is famous for the following: focusing on long-term value, ignoring the day-to-day fluctuations of the market, including a margin of safety to minimise risk, securing a well-chosen diversified portfolio based on reasonable prices as the soundest long-term investment, reinvesting returns, being financially and psychologically prepared to deal with short-term market fluctuations, being able to say no unless all the facts are in your favour, being content to hold any security indefinitely, and not trying to analyse or worry about the general economy. Buffett also argues that investment success is not the same as infallibility. Instead, success comes about by doing more things right than wrong. And to do that, you need to reduce the number of things that you can get wrong and focus on the things that you expect to get right. And again, this is where time is either your biggest friend or your worst foe, because taking time, patience, and persistence to achieve success are now greatly undervalued and unfortunately quite often forgotten. Unfortunately, everything in today's consumer world is designed and built for immediate use and results. Everything's short term. It has a defined shelf life and unfortunately is quite often throwaway. The age-old values of built to last and long-term loyalty no longer seem to have a place. Everything from clothes to computers to cars has ever-shrinking lifespans and is then thrown away. And this is carried over into jobs and marriages. Is it any wonder that patience and persistence are muscles that no longer get much exercise? But a review of all the great investors from Warren Buffett to Robert Kiyosaki shows that adopting a long-term strategy fused by patience and persistence produces the best sustainable outcomes. If you're going to succeed in investing, you'll need to include these qualities in your regular wealth care fitness routine. And patience is more important than smarts. And denying this is why a lot of investors don't achieve the results that the market freely offers in the long term over 10 or more years. Unfortunately, most investors aren't long-termers. They expect quick results and are constantly seeking the thrill of something more or the false promise of the next shiny new thing. They're either convinced of their ability to time the market, which usually leads to dismal outcomes, or they're emotional pendulums, buying at the top of the market and selling at the bottom, which obviously leads to disastrous results. Volatility in investment markets is normal. As I said before on Get Invested when quoting from the Freedom Formula, according to the great Morgan Housel, author of The Psychology of Money, the only real difference between long-term investors and the average investor is this. Long-term investors view volatility like the flu. Yeah, it's not fun. It can hurt, but you're probably going to get it once a year. And when you do, it's not the end of the world. Drink some water, take a nap, wait it out. Life will go on, and you'll be healthy before long. On the flip side, average investors, on the other hand, view volatility like stage 4 cancer. Something that shouldn't occur, should be utterly feared, and attacked mercilessly with the most extreme treatments. And in our currently rapidly moving world, long-term investors are sometimes heckled for being too simplistic or not astute, or ideologically worshipping a theory that for some reason some think has now been discredited. For Housel, however, the scores are in. No true long-term investor has ever lost money, while the vast majority of short-term traders and market timers definitely have. And as Warren Buffett says, much success can be attributed to inactivity. Most investors can't resist the temptation to constantly buy and sell. And reinforcing this, the author of War and Peace, Leo Tolstoy, once famously said that the two most powerful warriors are patience and time. So remember, great achievements take time. There is no overnight success. Continuing this theme of sharing some of the best investment advice from the likes of Buffett, Ray Dalio, Charlie Munger and Jim O'Shaughnessy and other investment greats, let me share some other timeless investment principles and lessons learned that have shaped and guided my investment over the years, which has been captured perfectly, again by Raman Nakisa from Pensioncraft, as follows. The first lesson is to avoid over-trading, which means that you just don't trade too often. Warren Buffett's got a beautiful analogy for this, and he says that calling people investors if they trade actively, which means too often, is like calling someone who repeatedly engages in one-night stands a romantic. Clearly, in his eyes, if you're an investor, you just don't trade that often. And extending his birds and bees analogy, he doesn't think many others can achieve long-term investment success if they flip from flower to flower, or in other words, if they're always switching investments. In support of this, the consulting company Dalbar does an analysis of investor behaviour, which they publish every year, where they show that over a 20-year period, the US S&P stock market averaged an annual return of about 8.2%. And yet the average investor return over that period was much lower at just 4.7%, or nearly half. And the reason for that is that the average holding period for equity funds was very short at just 3 to 4 years. During periods when markets turn downwards, the investor holding period becomes even shorter. So to be more successful, these investors could have simply held onto their funds for longer and then reap more of that 8% return. So the message again here is not to react to short-term market conditions. Don't sell when markets fall and buy when everyone else is buying, because this leads to bad decisions. Now, Jim O'Shaughnessy, who wrote the amazing book What Works on Wall Street, and he also hosts the great Infinite Loops podcast, so make sure you check out both of these, came out with an amazing thread in which he says that often in investing, the best thing to do is nothing. And yes, it's boring. Yes, it's incredibly dull. You won't have any great stories to talk about your market savvy at dinner parties or at Barbies, but he counsels that it's best to simply remain dispassionate about all the emotionally charged things which are happening. And if you do, you'll come out ahead of virtually everyone else in the long term. Another kind of bad behaviour to avoid is that you shouldn't chase returns. Or another way of thinking about this is you should try to avoid following the herd, unlike the crapping cows that I spoke about earlier. In fact, Warren Buffett also describes fear and greed as being like super contagious diseases. He never tries to anticipate the arrival of these diseases, but when they do arrive, he simply attempts to be fearful when other people are greedy, which is to say he sells when markets are too high, and he attempts to be greedy when others are fearful, or in other words, to buy when other people are selling. One way to tell whether people are greedy or fearful is to look at how many dollars people are willing to spend for every dollar of forecast profit. When markets are overpriced, as they were in the dot-com bubble, people were willing to pay about $23 for every dollar of earnings. And during the global financial crisis, investors were willing to pay just $8 for every dollar of earnings. And with a current S&P 500 index running at a price-to-earnings ratio of 34 against the average mean of just 15.95, you can see that equity markets are currently expensive because people are paying a lot more than usual for every dollar of profit that's forecast. Whereas at the height of the global financial crisis, equity was cheap. This may also be why Warren Buffett is still sitting on most of his cash pile, because in this market, despite all the terrible economic news, it's very difficult to find bargains. To characterise this in Warren Buffett's terms, investors are currently very greedy, which is probably why he's being so fearful. As an investor, you should always try and have a long-term perspective, or as Buffett says, some things just take time no matter how great the talent or effort. You can't produce a baby in 1 month by getting 9 women pregnant. And one of the best stories which illustrates the patience of Warren Buffett is the one about his purchase of Coca-Cola. In 1988, he bought 14 million Coke shares, which was a large proportion of all of the shares he owned at the time. And when he talks about his investment horizon, he said that he expected to hold these securities for a long time. And he said that his favourite holding period is forever. He described his company Berkshire Hathaway as the opposite of those who hurry to sell and book profits when companies perform well, but then hang on to businesses that disappoint. What about you? Do you sell winners too early and hold on to losing investments hoping that one day they'll come good? Well, Buffett carried on building his investment in Coca-Cola right up until, by 1996, he had 100 million shares. Now, overall, he paid about $1.3 billion for the shares, which are currently worth about $22 billion. Now, that's an annual growth of about 10% per year, and that single shareholding shows the long-term reward of Warren Buffett's patience. Now, what's pretty surprising about Warren Buffett, given he's probably the world's greatest stock picker, but spends all of his time researching them, is that he's quite negative about active equities management, which is the ability to select stocks that outperform the broad market. And one of the things he dislikes most are high fees. And he says it's usually the managers who reap outsized profits, not their clients, which is why it's usually the Wall Streeters that own most of the yachts in the marina and not their clients. And consequently, he thinks that it's better for large and small investors to stick with passive low-cost index funds. And he gives a really simple example to understand why low fees are important. If passive investors achieve average results before costs, because by definition they just buy the whole market, and if active investors form the rest of the market, then they must also achieve, on average results before costs. And then he points out that whichever group has the lowest costs is therefore going to outperform. Now, this doesn't mean there are no active managers which can outperform the market. It's just talking about the group as a whole. But the consequence of this is that the great majority of managers who attempt to overperform will fail net of fees. And if we look at the S&P's index versus active report, which is updated every 6 months, then over a long 10-year period, the vast majority of funds are outperformed by their benchmarks. In fact, only 3% of the funds beat their benchmark, and this represents a catastrophic failure of the entire active fund industry. And also explains why many people are taking Warren Buffett's advice and shifting to passive index funds that represent and follow the entire market. Buffett rather unkindly says that 1,000 monkeys would be just as likely to produce a seemingly all-wise profit than stockbrokers, with one major difference. The lucky monkey wouldn't find people standing in line to invest with him. Now, the next lesson revolves around diversification. It's very important to keep a handle on the risk of your portfolio, and one way to do that is to diversify your investments. The famous investor Ray Dalio has described this as the Holy Grail, which is to achieve return while taking very little risk. And he's got a beautiful graph which shows the risk of the portfolio on the vertical axis, with high risk at the top and low risk at the bottom, versus the number of assets in your portfolio increasing along the horizontal axis. Now, the key thing here is that as you add more uncorrelated assets, which means investment assets that generally perform out of sync with each other, and another way of saying that is if two assets are considered to be non-correlated, the price movement of one asset has no effect on the price movement of the other asset. For example, historically, stocks and bonds are used as examples of two uncorrelated asset classes. And diversification works best when assets are uncorrelated. So, as we go from left to right on Dalio's Holy Grail graph, the risk gradually drops on a descending ski slope curve until it reaches a plateau. If you combine assets with low correlation, the overall level of risk that you can achieve is much lower. And the key thing here is the probability of losing money in a given year if you don't diversify at all with just one asset is about 40%. But it's dramatically lower if you do diversify. For example, if you have 20 different investment assets with zero correlation, the probability of losing money plummets to just 11%. The key thing here is that when you choose multiple assets, or as Dalio calls them, return streams, you never know which one is going to outperform. But by diversifying this way, it reduces your risk, while you wait for at least one or more of them to generate that income. So the goal of diversification is to increase the number of units of return you receive for every unit of risk that you take in order to generate those returns. Or in finance speak, you're maximising your risk-adjusted return. So however you invest, you need to maximise your diversification by choosing investment assets that are uncorrelated. For most investors, holding a combination of stocks, bonds, property, cash and gold over the long term will do the trick. These assets all tend to perform in a less than correlated way and in combination can help dampen the overall volatility of your portfolio. The final investment lesson is to be very wary of market forecasts and projections. Not ignore them, but just take them with a pinch of salt. Charlie Munger, Warren Buffett's long-term business associate, puts it very memorably when he says he doesn't use formal projections. He says, I don't let people do them for me because I don't like throwing up on my desk. But he sees them being made in a very foolish way all the time. And he says many people believe in them no matter how foolish they are. Similarly, Jim O'Shaughnessy amplifies this point of view, starting with a quote from Warren Buffett where he says that forecasts create an illusion of apparent precision, and the more meticulous they are, the more concerned you should be. Jim points out that people tend to take recent events and project and forecast similar returns into the future, which is a mistake relating to what's called recency bias. He quotes David Drummond's book, Contrarian Investment Strategies, The Psychological Edge, where he studied analyst and economic earnings growth estimates over a 30-year period and looked at the average annual percentage error in those estimates. For the share analysts, it was a huge 81% error, and for the economists, it was a 53% error. So, share analysts were only right about 20% of the time, and economists were only right about half the time. You might as well go and flip a coin. So in summarising these timeless investment principles and lessons learned, 1, it's all about time. 2, don't waste your time and money trying to outperform the market. 3, investments behave randomly in the short term. 4, avoid the traps and costs of overly active trading. 5, don't chase returns. 6, diversify across uncorrelated assets. And 7, be very wary of investment market forecasts and projections. And the best way to inculcate these and other investment lessons is to continuously improve your investment education, which is where today's guest Andrew Baxter may be one of your options to consider when it comes to stock market investing. Andrew is the founder and CEO of Australian Investment Education. His career started at the hub of global investment markets in the City of London. There he worked for some of the largest institutions, building up a broad-based expertise in trading and investing across global markets. Since he moved to Australia back in 1999, he's been on a mission to educate and empower everyday investors on how to build better returns, manage risk, and ultimately enjoy a richer life. He's been invited to speak around the world alongside some of the biggest names in the personal development and wealth space. And in Andrew's own words, his flagship Australian Investment Education brings together the complexities of financial markets and distills them down into simple bite-sized chunks that just about anyone can follow. In addition to training and education, Andrew Baxter is the owner and director of a number of companies ranging across areas such as advisory, financial technology, brokerage, financial planning, and accounting. You can find out more about Andrew and Australian Investment Education on his Money and Investing podcast or at www.australianinvestmenteducation.com.au and their Facebook page. Now, I need to point out that Andrew reached out to us to appear on Get Invested, so I can't personally vouch for him or the quality of the education and investments that he delivers. But I can say that our investment philosophies and approaches certainly appear to align in many areas, as you'll hear in our conversation today. So if you reach out to Andrew and the Australian Investment Education team after listening to today's conversation, you'll need to do your own detailed due diligence before deciding to proceed. I also stress that Australian Investment Education's cash flow on demand options trading strategy is not for the beginner or the uninitiated. There are inherent unseen risks in options trading if you don't know what you're doing. So ensure that you fully educate yourself and historically backtest your trading system in detail before you put your hard cash on the dash. Again, it's all about investing in your education first before investing in assets. Now, in our lively and entertaining chat today, Andrew talks about away and towards values and what this means. We discussed the danger of assuming your work success will translate into investing success. He outlines his cash flow on demand options income strategy. He talks about the importance of intention and motivation and self-reflection on your investing success. Andrew stresses the need to really know yourself and where you want to get to, along with the importance of developing your process in line with your skills evolution. We cover indices versus stock picking, exchange-traded funds, passive investment, diversification, and Andrew shares his view on the risks of the unregulated maverick crypto market and the future potential of blockchain technology, plus much, much more. And if you're interested in increasing your self-health wealth investment education, feel free to join me and many other like-minded investors in our Get Invested community. And I'd love for you to join us right now. I send you a free and exclusive monthly email full of practical self-health and wealth wisdom that our current Freedom Fighter subscribers just can't wait to get every month. It's full of investment and lifestyle tips, my personal book recommendations, apps I use to enhance life, and a whole bunch more. Just visit bushymartin.com.au and sign up at the bottom of the page, because this is just the beginning. And it's also the beginning of my great chat with Andrew Baxter. Hi Freedom Fighters. Now, since early last year, we've been buried in a non-stop deluge of mainstream media fear feeders, painting often conflicting stories of gloom, doom and boom for both industries and individuals. And the constant threat of reactive rolling lockdowns is seeing the majority of Aussies confined to their homes at the moment, and with international borders closed indefinitely, population growth has ground to a halt. Yet despite this negative backdrop, asset prices continue to boom. So how do we make sense out of this enormous dynamic complexity and uncertainty and invest with confidence in the current climate? Well, it all starts with investing in your knowledge and education, So you're better prepared to read the winds of change in order to adopt different investment strategies that are applicable and adaptable to the world of constantly shifting sands. So to assist empower you to build better returns, manage risk, and ultimately enjoy a richer life, we're joined by a successful investor turned educator, Andrew Baxter. So welcome, and let's get invested, Andrew.
Great to be on the show, and thanks for having me.
Thanks, mate. For those who don't know who you are and your background, can you start by just giving us a rundown on who you are, what you do, and most importantly, why you do what you do?
So my primary role, I'm the CEO and founder of an organisation called Australian Investment Education. What we do in a nutshell is educate everyday people on how to better manage their money with a focus predominantly toward the stock market and in particular some pretty smart strategies within the stock market that can then help them with their income and most importantly manage risk. Why I'm in that space? Look, my journey has been an interesting one. I'm from a pretty humble start in life, and I feel that I'm on a mission to help everyday people get access to some of the information that the big end of town have really been able to enjoy for decades, if you will, level the playing field and give people a fair go.
Yeah, no, very fair call. Well, let's dive into that history, if you don't mind, and take us through where you've invested your time, your energy and your money over your life journey to date, with a particular focus on what you've learned from that and how it's shaped where you are and what you're doing now.
Look, I think like most people, we start with a blank canvas, which is coloured in to an extent, I think, from the stories our parents give us and the role or benchmarking, if you will, that our parents give us. And, for what it's worth, my parents, they both work pretty hard. They're working class, saved their money, paid their mortgage off and saved for a retirement. And I think, that's the atypical path for a lot of people. But early on in my life, I was very, very fortunate. I had a part-time job after school, which most people have. I think it's called slave labor these days. But and my father was very, very keen to push me into doing that to get what he referred to as a degree from the University of Life. So, I worked pretty hard. I saved my money from there, had a couple of sidelines and built up a bit of a nest egg. And my first investment was actually in some shares. We'd been learning about the share market at school, so I thought I'd give it a go and put some of my very hard-earned money. I was earning £1 an hour at the time, so it certainly was hard-earned money, into the market.
Awesome. Well, let's talk. I'm going to drill right in there. What did you? Can you remember way back when? How old were you then, and what did you actually invest in at the time?
I was probably about 15 years old, and it wasn't a great investment because I lost a decent chunk of my money, which was a bit of a wake-up call. And I think, people typically can have quite a strong emotional attachment to money, particularly if you've had to work hard for it. And at £1 an hour, I'd certainly done that. And it was a real wake-up call at that tender age to say, listen, son, before you go doing this again, and I wasn't going to give up. I'm quite a stubborn and determined person, as I'm sure you'll glean over the coming conversation. If you're going to do this, don't be so stupid. Work out how this is supposed to work and start learning a little bit more, particularly about risk management. So literally from my very first investment, risk management was drilled in. From there on in, I invested in my education heavily, and it's paid off in spades over time for sure.
Awesome. Well, it takes a fair bit of balls for a 15-year-old to have a crack at the share market. There wouldn't be too many 15-year-olds who've actually put their hard-earned into the market at that stage. So you've got a fair bit of courage right off the bat. Talk to us about where that led you to, both professionally and investment-wise from that point on.
Well, investment number 2 was a totally different kettle of fish. I learned a little bit more, and I invested. It was actually in a company called Abbey National, which was a building society in the UK. And I put about my second investment. I went big. I put in, I think it was something almost £5,000. Wow. And over the course of a fairly short period of time, turned that into over 25 grand. And for me, it probably lit a candle more than anything, because I'd watched both of my parents work hard. My dad worked in a car factory. If there's no overtime there, he worked on a building site to make more money for us. And my mother was a cleaner, so I'd always seen my parents work hard, exchanging their time for money. And I'd never really seen money work hard for them or for me? And in that investment, turning that $5,000 into 20, 25 grand. Well, firstly, that was more than what my dad was earning in a year, busting his back in a car factory. But number two, all I'd had to do was, at that time, there's no internet and there's no clicking a button to buy shares, but all I'd had to do is fill in some paperwork, and that money had magically grown passively for me. And it was like, heck, this is all right. It's a lot better than earning £1 an hour at the bakery. So this might be worth spending some time on it. And so that kind of was where I got hooked, if you will, and that was really the start of what now is being, several decades later, where my career path has been in trading and investing and helping people do the same.
Great. Well, that certainly would have whet the appetite, no doubt. Talk us about that journey. So you left school. Where did you go to from there, and how has that sort of guided your trajectory since then?
Well, I finished school. I worked pretty hard at school. My mum and dad always said work hard at school so you can get a good job. I worked hard at school and got into university. I graduated with a Bachelor of Science with honours in economics and finance. And for anyone listening to this that doesn't have that background, lucky you, because one of the things that I've come to observe, and I don't say that flippantly, education is not a heavy burden to carry around. It's a very important piece of paper that can help open a door. But the reality of my experience, particularly over the last couple of decades where I've focused on teaching people, is that the more letters people have after their name, the more they already think they know everything about everything, and they're less open to being educated perhaps than someone that doesn't have that background. And that's a really interesting distinction, certainly within the education journey. So, I graduated. It was actually right in the middle of a recession in the UK when I graduated. There weren't a lot of jobs around. I was contemplating joining the Royal Marines, as a matter of fact. And fortunately, I did get a job in a bank, a temping job initially, and then very quickly progressed that through to where my career really started properly, I suppose, in the city of London, working for a couple of fairly substantial investment management firms, where we managed billions and billions of dollars. So that was a baptism of fire, that's for sure.
Absolutely. How did that lead you to the good old land of Oz and what you're doing now? What was the transition?
Look, I was doing quite well at what I was doing, and I'll make no secret about it. It was also pretty stressful, being a trader. In what is the hub of the world's financial markets for a large institution. Just to give you a bit of a metric on that, I worked out one day I was drinking about 23 cups of coffee a day. Some of my colleagues had other vices to manage the stress, but that happened to be mine. And as it happened, I was dating an Australian girl, and she knew I was. The irony was, my goal at that stage in life, having sort of grown up in a fairly financially poor environment, very loving environment, but certainly not wealthy by any stretch of the imagination, was that I was in the pursuit of money. And whilst I was making a lot of it, and I know this sounds crazy, particularly when you're talking about, we're in the genre of wealth creation and helping people learn how to do that. But I wasn't fulfilled in the slightest, because I think money, yes, you need some, you've got to have a roof over your head and all the different needs that we have. But it's a very, very hollow goal, because it doesn't matter how much you have. If someone's got more, you're going to be pretty dirty on yourself for not being ahead of them. It's a very, very difficult benchmark to have. And I was making great money. I was doing beyond what I ever expected to make, but I wasn't fulfilled and I wasn't happy. And for me, she said, she said, "Do you want to come out for a holiday here?" Which I did. And on that rather lengthy flight from London, I guess there's a couple of things you could do. If you're David Boone, you can drink 50 cans of beer. And in my case, I picked up a book at the airport bookstore called Rich Dad, Poor Dad by Robert Kiyosaki. And that transformed my thinking, and it certainly transformed the journey that I was on, because I devoured that. I went back to London after my holiday, but I realized that I was done in the UK and I wanted to go somewhere where I felt there was more opportunity and less old school tie. Going to the pretty rough comprehensive school I went to in Swindon in Wiltshire in the UK, there was no old school tie network or advantage to be had from that, and you're kind of up against it in a city like London. So I decided I would up sticks, and I moved to Australia just under 2 years later, 1999. Best decision I ever made.
Yeah, well, it's interesting, mate. We've had similar roads. The book that changed my thinking was that very same one. I call it my Kiyosaki moment, actually. Completely flipped my lid and I've lived a very different life ever since. And you make a very good point that's worth touching on, because I often say to people when they come to talk to us about investment, the first question I ask is, how much is enough? Because if you're clear on exactly how you want to live and you know what that lifestyle costs, all you need to do is invest to a level that's going to generate that income without requiring you to be doing it 40 hours a week. And you've got your time back to put into things that matter, rather than chasing the elusive rainbow and the gold consistently to the point where you're killing yourself and hating life as a consequence.
100%. I mean, I was chasing the wind, as I guess we all do when we're younger and perhaps less evolved. And I was turning into a really cranky person, stressed, which is not my natural disposition at all. And I wasn't happy with the person that I was becoming.
Yeah, awesome. So you got over to Oz. Talk to us about what happened from there. Obviously, it sounds like you probably got married to the
No.
No, you didn't. Okay.
That didn't work out, unfortunately. I'll always be grateful for her opening the door up and her family for opening the door for me to come over here. But no, I went through a fairly hedonistic, probably 15 or 16 year bachelor period after that, but I'll probably leave that for a different podcast than today. So look, I originally rocked up into Brisbane, and it's a city I still hold very dear. It's a wonderful place, and I'm a very proud adopted Queenslander. I think looking for a job initially was pretty difficult, and I remember I did have an interview with a stockbroker. And they said, how many people do you know? And I said, well, 4. And they said, well, you've got no chance of cutting it in this. Sorry, we can't hire you. See you later. And interestingly enough, to square that story off, I bumped into that particular CEO of that stockbroking firm about 2 years ago at the Stockbrokers Association dinner. And he said, oh, go on then, how many clients? I said, I've got over 60,000 clients now. He said, I should have hired you, shouldn't I? I said, I'm glad you didn't, because it forced me down a very different path. And I think every time there's a setback, you can look at it in one of two ways. You've stubbed your toe and it hurts, but you've got to get past that emotion, stop babying yourself, get back up and come out swinging and find the next opportunity. And that's something that's really important. So, I traded from home, and it was a good time to trade from home because the dot-com boom, this was back in 1999, the dot-com boom was running hot.
Yeah.
And for some people that perhaps are a little younger, listening to this, to hook into online trading, which was this new thing, you had to pull the cord out the back of the phone and tuck it in your computer and have a go. That's how long ago we're talking.
Well, I'm right there with you. I was doing some day trading around that time, and it ain't anywhere as easy as what it is today.
Oh, it's so easy now. People don't realize how easy they have it now. But so I was going pretty well, making some great money, and I ended up getting some software to help with my trading. And the dude that was selling it said, "Look, I've got," and it was really good software. And he said, "I just can't get people to subscribe. They sort of they kind of have a go and they blow up." So I said, "Well, have you considered teaching people?" And I actually wrote a training program for him based on what I used to do in London, and it didn't particularly work because it was too technical. And I think that's probably one of the big learning points for me, is that part of the reason we've been so successful with Australian investment education, much like yourself, is taking the complexities of the investing landscape and being able to break them down into bite-sized chunks that anybody can follow. So I met this dude I was playing golf with, and he was sort of retired, and he said to me, "How come you're not at work today?" I said, "Well, what do you mean? How come you're not at work today?" He said, "Well, I'm retired. What's your story?" I said, "Well, so am I." And he practically fell off the golf buggy when I told him that, because he said, "Well, how?" And I said, "I trade." And he actually became my first personal client that I taught how to trade. His name was Ray. And he came to my house, and we'd huddle around the computer, and over a period of 6 or 7 weeks, we'd trade together, and I got him up and running. And I thought, hang on, this is crazy, because this is second nature to me. I've spent a long time in this space learning it, and I take it for granted that it's normal knowledge, and it very clearly isn't. And seeing the transformation that it made for him, and the timing of this was good too, because it wasn't just the dot-com boom, of course, it was the dot-com bust. So that really helped me develop risk management for my clients, and they did very well through that period of time. He was my first. He referred me to some friends. Next thing you know, I've got this little cult going on at my house where there's sort of 8 or 9 people coming over every day, and my girlfriend at the time's going, "Who are these people?" I said, "Well, we're on a journey together. Leave us to it." And it's crazy when you look back at it, but that's how this whole thing started. It was embryonic, and that's how it started back in '99.
Love it. Well, let's project forward a minute. You may already be living your ideal lifestyle, but paint a picture for us. What does it look like? What are you doing? Where? When? With who? And what does that cost? And what are you investing in and have invested in to make that happen?
Look, I've invested across a lot of assets, and I still do. And it's, oftentimes, you've got the age-old battle, property versus shares, for example. It's like having a discussion of Trump, Biden, or oil and water. The people always say it's got to be one or the other, and it really doesn't have to be. In fact, it should be both. And, I've done my fair share of property investing, and it's been very, very kind to me. I've had a couple of doozies in that space too. But by and large, property's been very kind. I've developed, I've bought and renovated, and I've had other investment properties. So I've done a few different things in that space, and it's been very, very good to me, and continues to be good to me. My main bread and butter is in the stock market, and we've got a particular way of approaching that. And COVID and the lockdown that's gone around that, I think, has been a huge positive. And I know it's hard to, and I go back to what I said before, when there's something that happens to you that's not necessarily a positive thing to be seen, you've got to find the good in it. You've got to come out swinging and find the opportunity. Yeah. And COVID, I think, has forced an awful lot of people to realize that just relying on a job is something you can't rely on, and there's no permanency to it in today's economy. And number two, having a second form of income is no longer a luxury, it is a necessity. And so, we've had a huge influx of people looking to do this. I'm sitting in my house here. I live on a farm with my family. I've got 5 young kids. My wife's here. We're down at our farm down here in Byron Bay. And life is good. I couldn't wish it to really be any better. My income, if anything, has probably increased through the period of COVID because markets have been very conducive. Yep. And technology has really facilitated that. You could be anywhere on the planet and trade successfully. I'm on a farm where there's no internet, so I've got a 22-meter tower at the end of one of the paddocks here, and it's powering our internet. I could probably cook food between the tower and the house. There's a fair bit of data going that way. And that ability to be flexible and live where you want to live, on the terms that you want to live, doing what you want to do without it making any impact at all on your income is incredible. And I've got a picture sitting in my office right now behind me of my days on the trading floors in London. And there wasn't one window on the live floor in Cannon Street, not one window. You didn't see the sun from 8 o'clock in the morning till 4:30 in the afternoon when I finished. Didn't see the sun for probably 4 months of the year through the week. And yet I can sit here overlooking a beautiful vista and make more money doing that. That's how much the world has changed. And that's what's called opportunity. It just comes wrapped in some extraordinary wrapping paper that doesn't always look that appealing at times.
Totally agree. And I'm starting to realise we're a lot more similar than what I thought, Andrew, because made very similar decisions and very similar lifestyle decisions. And I'm with you. I think great periods of change create the best opportunity, actually, if you're nimble and adaptive enough to take advantage of it and have the courage to follow through. And you're right, I think COVID's been a massive wake-up call and a shake-up call. And as you say, a second form of income is now mandatory because for those that are living hand-to-mouth, and unfortunately there still are a lot of Aussies who put themselves in that position, and their whole world revolves around their work or their career. Now, there's no certainty in that anymore. And if that dries up, then life looks pretty challenging. So unless you're investing beyond your work, career, your business, then you're putting yourself in a major risk position given the winds of change that we're going to continue to have to contend with as we move forward. So love your thoughts on that. Let's define success if we can, because everyone has their own definition. What's your definition of sustainable success? And I'd like to underline the sustainable piece, because there's a lot of one-hit wonders out there at the moment. How would you define it, mate?
Look, I think that's definitely something that's changed in terms of the lenses I look through. If I look in my younger days, it would have been just about money and income and probably ego, which, as a young man probably comes as no surprise. I think as I've gotten older, I've come to realize that success really comes through choice. And I think it comes through control. And I don't mean that to be that you need to be a control freak, but you certainly need to be able to be master of your own destiny in order to give you the freedom, if you will, to make the choices that you want. And over time, I think my measure of success has gone very much from being just simply about dollars. And don't get me wrong, they're still important. They pay for the ability to buy your time back. Yep. To genuinely wealth, which I define in quite a different way. And I think we're, again, probably quite similar in regards to that wealth is about choice as to how you spend your time, who you spend your time with, and what you spend your time doing. And so that's definitely where I would see the benchmark for success now is having more wealth, not measured by money, but measured by time, and particularly not just time as an overarching title, but discretionary time that you can choose what you want to do with that time.
Spot on. Absolutely. Yeah, we're on exactly the same page as far as that goes. Now, let's sort of jump into the world of investment and trading, given your expertise in that area. And I think given some of the educational work you're doing and some of the programs and courses you're running, there's some particular opportunities at the moment in the context of what you're doing there. But to kick that off, I'd love for you to, again, I'd like to define the ground so that we're all talking about the same thing and the audience are understanding what we're talking about. How would you define the difference between speculating, trading, and investing?
So I think a speculator is someone that's taking, for want of a better description, a punt on the direction that something is going to move in. And look, it's not unique to the stock market. You could be talking about crypto, you could be talking about Forex, you could be talking about property. You're taking the punt that I'm going to buy this and I'm going to look to move it on as and when it hits my price target, hopefully sooner rather than later. And you're kind of working your account, turning it over reasonably aggressively. An investor is someone that's probably defined by time as someone that's taking a much longer perspective. They're playing the long game. So rather than put the pressure on themselves of having to get the time right and making a guess, and that's a very deliberate word, by the way, that I'm using. You could call it a forecast if you preferred to sound more sophisticated, but the reality is a guess, just like everybody else. It's just a question of whether your guesses are better than other people's. Yeah. An investor is taking a little bit of the guesswork out because they're giving things longer to work. And I guess it's one of those things, if you give anything long enough, you'll be right. There's a particular speaker out of the US I've done work with over the years who's been calling for a collapse in the stock market and the property market for the last 15 years. And the irony is one day he will be right, but then so too is a broken watch. It's right twice a day. It doesn't mean to say it keeps time. And so, as an investor, if you give something long enough, your view is likely to be right at a point in time in the future. So you take that pressure off of the time frame of what you're doing. So broadly speaking, I would say that's probably how I'd see the two. And both of which carry with them, fairly substantial flaws as an approach. There are much better things that you can do where you can apply a blend of the two in a very, very smart way to help stack the odds more in your favor for success, removing the reliance on guessing it right and removing the reliance on for it to have time to be right, and actually stacking that in a different way. And that's very much the place that we occupy within the markets. Not speculative, not investing, just a very, very strategic strategy that sort of comes, I guess, from learning this at the coalface in London, 30 years ago.
Well, you've sort of opened the gate to talk about that. Let's dive in there right now and sort of give us a bit of an appetite whetter on what your approach is and who that's relevant to.
The approach that we take for our ecosystem, for our clients, is rather than base your investment decision on a forecast or a guess, and most people's investing is based on, in order for them to make money, the market, irrespective of what asset, as I say, it could be Forex, could be crypto, could be property, the asset needs to appreciate in value for you to make money. But particularly when it comes to stocks, they don't always go up. Sometimes they go down, sometimes they go sideways, sometimes they do all three in the same day. It's like Melbourne weather. It gives you plenty of excitement. The reality is, if that's the foundation of your investment strategy, where you've got to guess it right, and any one of those three things can happen, your odds of success are about 1 in 3. They're terrible. You'd be better off going to the casino playing red or black, and that's by no means what my investment advice is. But the reality is, the odds are stacked against your success before you even start. So rather than base your investment decision on having to get the direction of the asset right, the strategy I use, and I use a particular type of investment class called a derivative, which some people have horror stories around, and it's probably because they don't know how to use them. Yeah. And what it enables me to do is base my whole strategy around a guaranteed event. Now, guarantees are very interesting to talk about when we talk about the stock market. And the guaranteed event I'm talking about is time passing by. Yeah. And what I'm effectively looking to do is to get paid for time passing by. And it doesn't matter who you are and what you've smoked. If you're listening to this, you would have to universally agree that time passes by. We've been talking for 27 minutes. 27 minutes has passed by. You can't argue that hasn't happened. And so if you construct your investment about being paid for that time to pass by, you're now on something that is a certain event. Your probability of it being an effective outcome is significantly higher, maybe 80, 85%, as opposed to 1 in 3. Yeah. You've tilted the deck in your favor, and now you've got a playing field that you can run on with a level of confidence and certainty as to what you do.
Okay, now I'm guessing you're talking about options here, given the impact of time on that exercise. Can you put a little bit of colour around that? Because it's probably an area that a lot of listeners don't really understand, or if they do, they probably know enough to be dangerous. So you're able to shed some light on that for us?
Let's start with the dangerous side of options. A lot of people do see them as being dangerous because they haven't been taught by a pro. Yep. In just the same way, you could argue that, your motor car, do you see your car as being dangerous? Well, if it's in the you drive it to get a latte with your partner on a Sunday morning, observing the speed limit and not using your phone, it's probably reasonably safe. But if we're talking about 3 o'clock in the morning and you're doing donuts in the Bunnings car park at Moonee Ponds high as a kite, then the car it's the same vehicle, but the way it's being used is in the wrong way, and it's going to be quite dangerous. And really, investment assets are just the same. If they're used in the right way, they're not dangerous. So in a nutshell, if you own a portfolio of shares, whatever it may be, let's say it's CBA, for example, what you're effectively doing is holding an asset in the hope that it's going to go up in value over the course of time, which it's done quite well over the last 18 months. And the payoff for you holding that asset is that at the behest of the company, twice a year, they're going to pay you a dividend. There's your income. The big challenge for most people is that they don't get bills twice a year. They get bills more regularly than that, and they need income to be flowing more regularly than that. And secondly, companies can turn down their dividend, as we saw last year during COVID. So all of a sudden, if you're a retiree, for example, and you're relying on dividends to fund your retirement lifestyle, and all of a sudden the company comes out and says, we're not paying a dividend this year, that's your income turned off and you've got no control over it. Yeah. So what we do instead is rather like property. If you own a portfolio of shares and you don't use the strategy I'm talking about, it will be just the same as owning an investment property and neglecting to put the tenant in. You've got the asset, and the asset may well go up in value over time, but you're missing out on that weekly or monthly rent check, which is the whole gig. Yeah. And so in a nutshell, what we do is use options to help us harvest that weekly or monthly rent over shares as opposed to over a property.
Yeah, love it. Yeah, a really good analogy, the way you've described that. Tell us about the risks that are associated with that, because again, for those that have a lot of courage and not a lot of time, they might jump off this podcast and race out and throw some money in options. Talk to us about what they need to be aware of and how they can protect themselves to make sure that they aren't sort of running the gambit on risk as far as that goes.
Yeah, and that's a massive thing to flag. If you're thinking of running out and diving into this place, please don't just now. It's kind of like learning to swim. Get in the shallow end first, get to see what water feels like splashing on you, and then over time gradually move up to the deep end. Don't jump in and drift down to the bottom and bob back up gasping for air. That's not what successful investing is. It's a pretty stressful thing to do, and ultimately it's probably not an experience, unless you like being waterboarded in your part-time activities. It's probably not something you want to do too often. So very, very specifically, any kind of successful investment, success leaves clues, an overused cliche, but nonetheless true. And I think you have to build up a process in the first instance. You don't just, here's some shares, let's sell some options and see how we go. There are nuances within there that you need to get right in order to really, A, de-risk what you're doing, and then B, actually fully understand the ups and downs of where you're at. So in terms of a strategy itself, and the strategy, we call it cash flow on demand. That's the name that we've given this particular strategy. And it's a lower risk strategy than simply owning shares, for the simple reason the money you get paid on the option side of the ledger is gradually reducing the break even or your average cost for your shares. So you're actually dropping your average entry cost for the shares by doing this, meaning you're taking some air out of the balloon and de-risking the trade sum. That's a way of managing risk. There are two or three other ways that we do more proactively. We can insure our shares. I'll talk about that in a moment. We can use things like stop losses, which is, in case of emergency, break glass, get out. So there are things that you can do on that side, but the most important one in the first instance is to get educated very, very specifically on that. And it's not something you're going to glean from YouTube. Sure, you're going to pick up bits and pieces, but going to YouTube to learn stuff, even though there's some brilliant content there, is kind of like trying to do a home renovation. You might want to do the plumbing. You get into Bunnings and buy all the gear to do it, only to discover that you're trying to connect metric stuff to imperial and it doesn't work because it's disjointed. And in the same way, you need something that's going to seamlessly run through everything that you need to in this. So certainly get educated to de-risk this in the first instance. Secondly, is where you choose to play in the markets. There are things that can draw people in, which I've seen, a couple of promoters around and about doing this. Well, my clients make, 5, 6, 7% a month. Yours make 1.5 to 2.5. Yeah, but mine do that every month for as long as they want, versus being a shooting star where you might do it 2 months in a row and then your account is decimated. So, picking the right kind of stocks to do this is crucial too. And probably the best way to explain that to someone is to use a parallel example of, say, Indian food. Now, obviously, I grew up in the UK, so Indian food is my national dish over there. And over time, your palate changes. If someone's never had Indian food before, it'd be pretty cruel, and we've probably seen people do it, to take them out to a restaurant and order a really red-hot curry just to sit there and watch them, die and be licking bread and drinking milk trying to get rid of the pain. Start off with a butter chicken or a chicken korma and gradually move up through the ranks until you get to a level of spiciness that you're comfortable with. And trading and investing is the same. You can have butter chicken in terms of a trade, or you can have a hot vindaloo if that's what you're after, but it comes down to your own particular taste. And learning how to grade your trades to make sure that you're not diving into the super hot chilies when you want something quite mild is a very, very important learning point for people on this journey too.
Yeah, brilliant analogy there, mate. Let's sort of circle around this in what we've been talking about already, but the role of psychology and mindset and understanding yourself in investing. What's your thoughts around that?
It's an area I think that people like to gloss over, Bushy, for the simple reason that if you embark on education, you want to get into the nuts and bolts of it, and see something that's new and exciting. And in my game, not that I'd describe it as exciting, I've seen too many of them over the last 30 years, but it might be looking at a chart or your analysis or your indicators that you're putting on there. And talking about who you are as a person and understanding what makes you tick is something that most people want to just leave in the cupboard because they're very familiar with who they are. Yet it's probably the most important platform to get right before you start. And this whole area, whether you call it personal development, which is a terrible term, or financial education, or expanding someone's horizons for life, they're all great things to look at. And it's not about changing who you are as a person. It's helping you become the best version of you that you can be. So anybody can be a trader. Anyone can be a property investor. Anyone can be a successful entrepreneur, but they need to play within the confines of what their personality strengths are, not their weaknesses. And so learning your personality type, what makes you tick, what motivates you. If I've got someone that's like an uber achiever in life, they might be very successful in business or in industry and quite high profile, and we've got clients in that space. They automatically project that success on starting trading. I've been successful as a businessman, so this will be a walk in the park. Let's go big. Here's $500,000. Let's kick off with that. There's more to come. And it's like, no. We have to start just like snakes and ladders, at square one, just like Joe Bag of Donuts does as well. And you're going to grow your knowledge together and go on that pathway properly. And it's very, very hard for people that have been successful to park that ego to the side and take it back to tin tacks and go, okay, I'm novice, I know nothing, hold my hand, be gentle with me, walk me through from ground zero. And it's the most important part of the journey. Start it right, get it right first time, and you'll build a platform for your success. But if you jump ahead, often because your confidence, or let's use a different term, arrogance, overshoots your competence and skill set, you're riding for a fall, and when it goes wrong, it's going to take an awful lot of bark off, and it'll stop you going down what could be a very successful pathway because you tried to skip steps. Don't shortcut. Sure, you can fast track, but do not shortcut. Get the mindset, the psychology stuff right, work out why you're doing it, and you'll crush it.
Yeah, love it. Now, extremely well said there. And you've touched on some of the mistakes that particularly early investors make. And you're right, the people who have been successful in other spheres just automatically assume that they can go gangbusters in something they haven't tried before. What are some of the other mistakes that you're seeing investors and traders make when they're starting and in the current atmosphere?
Look, I think you've got to get a gauge on what your motivation is for doing anything as well. And if you sit down and talk to someone early doors, and I'm sure you've had conversations with people that you've mentored in this space, so why are you doing this? Oh, I hate my job. That is not a good reason to do something. That's an away value. You've got to have a reason, a towards value to want to do something. So look, I'm looking at trading because I'm interested in this, and I want to develop a second form of income to help support my family or pay down my debt or buy my next. That's a different story to I hate my job and I want to find something else to do. So finding that positive momentum for wanting to engage with something, I think, puts a really different sphere around it. Secondly, and again, it sounds a little crazy, but I guess I've had the privilege now of educating 50, 60,000 people around the world on this stuff. And that is, if your focus in the early days is to make money, it's the wrong focus. Now, I appreciate that probably sounds a little crazy, but in the early days, your focus needs to be on building a consistency within your process and confidence within the process that you're using. Because if the process is right, the results always follow. But if you just focused on trying to get a quick win here or there to make some money and go, look, I'm being successful, I've made $1,000 today or $500 this week or whatever it may be, that's great. But if you haven't laid in the work to build a process that's able to do that over and over and over and over again, you're not building a sustainable future for yourself. And the second the wheels come off and you stop making that $1,000 a week or $500 a day, whatever it might be, all of a sudden your confidence and your momentum and your motivation is decimated because you skipped that crucial step. Consistency, building your confidence and nailing that process is the thing to focus on. And this was really noticeable probably over the last 18 months, where you talk to somebody, perhaps a self-managed super client, for example, where they go, look, I did really well last year. I made 30%. I don't need to learn about the stock market. I made 30%. You go, well, what did you make the year before? That ought to be interested in. Because last year, just about anybody should have been making at least that and probably more, because markets offered way, way more than that.
Yeah.
So what you've got is a situation then where someone, because they've been initially successful with that, the conditions have changed. This current climate that we're in, the economy has changed an awful lot. We don't have JobKeeper. Lots of things have shifted. The skill set to be successful in this market now is very, very different. That may have been beginner's luck. And I've seen people try and say, no, I'm not going to educate myself. I'll just keep doing what I did. I made 30% last year. I'll do the same this year. And they don't. They actually blow up. And all of a sudden, they sort of come limping back, tail between the legs, assuming, of course, they're humble enough to say, I was wrong, can you help me? A lot of people just disappear off the radar. And you can sit down and you can rehab those people, because they then understand the importance of getting a process in play as opposed to blind luck. Luck always runs.
Yeah, and you make a good point. I think, unfortunately, some people need to get a blood nose before they're ready to really to start learning. You touched on the importance of a consistent process and a system in relation to getting good results from your investing. Do you want to share some of the key components of that process so that the listeners are starting to get their head around what sort of things they need to be doing before they start to leverage up and ramp up the level that they're putting into the market?
Sure. Look, I think a really good comparison for someone that's say currently has cash, which let's face it is a dead asset. 0.1% before tax and inflation is you just put your money to sleep. You've got to get it working.
Yeah.
And if you're looking to say diversify, so say you're a property investor looking at the stock market, say you're in self-managed super, you've had managed funds. Obviously, we know 70% of those underperform the index, so you might be looking to do something different there as well. You think, well, I've never actually done anything in the stock market, and I don't know if it's my thing. I don't know if I can do it. If you think about, say, companies like Marley, Spoon, or HelloFresh, the food delivery companies.
Yep.
You may not enjoy cooking, and you may not be a good cook, and you may not even know how to cook. As long as you know where the kitchen is and where the box is being delivered, you can open the box. All the ingredients are in there that you need. There's nothing missing. The quantities are in the right quantities. You look at the card, there are 6 or 8 steps to follow with some photos to help you along the way. If you follow that process to the letter and then flip it over, lo and behold, what's on your plate looks exactly like what's on the card. The reason for that is they've taken the time to build a process that just about anybody can follow. It's paint by numbers. And that's exactly what we do in the trading space. So for somebody looking at this, you need to have that process in the first instance, because over time, as your skill sets evolve, you might choose to add more salt and pepper or some chili or whatever it may be to enhance the taste to your palate. But you've got to have a core process to come back to. But before even doing that, you've got to have an idea of what your end game is. And I think, do you want to be someone that has an income flow? Do you want someone that wants to have growth in your portfolio? Are you someone that's investing with a environmental and social bias, which again is another area we can dive into? Knowing what you want before you start is key, because if you have no idea what the destination looks like, any road's going to take you nowhere. And you can bimble around and spend years trying to, we're gradually getting there. The saddest thing for most people, it doesn't matter how much money you have, you never buy time back. Take the time to plan first. What do you want this to look like? Are you looking to have 100 grand in the market, $500,000 in the market, $1 million in the market? What does your timeline look like for ratcheting up? And more importantly, what are the milestones that you'll need to tick and go past to feel confident to go to that next level? So start small, build up some consistency. And when you've hit that consistency goal, then you move up to the next level. It might be adding more to your account and maybe adding some variety within your process, getting consistent with that and then leveraging up. But if you haven't taken the time to work out what the end goal looks like, you're never going to get there. You're chasing the wind, just like someone that's chasing money is their goal.
Yeah, it's absolute magic to my ears, Andrew. I often talk about getting really compelling about your why and making sure that you're absolutely clear on what the end game is, because that becomes both a magnet that'll make sure you jump the inevitable speed hurdles and bumps and lumps that you're going to have on the journey, but also a compass in terms of making sure that what you're doing day to day is taking you closer to that,
Absolutely,
rather than further away. Yeah, love it. Love it.
And let's face it, it's not always easy. There are going to be times that you're going to stub your toe. And if you don't have a clear enough intention, if it's not a strong enough reason why, that's where people give up. Oh, didn't work, move on to the next thing, chase something else that's shinier and have a go, instead of just rolling the sleeves up and going, okay, what went wrong? Post-mortem, okay, that was it. I can learn from that. My intention, my goal is strong enough to motivate me to want to do that hard work and that self-examination, not to beat yourself up psychologically and go, you're a Nimrod, what did you do that for? Everybody makes mistakes. I've yet to meet anybody that hasn't made a mistake that's achieved any success in life. I've got a wardrobe of T-shirts here for lessons that I've learned along the way, as most people have. So if your intention and your motivation is strong enough, you'll push through those hurdles. If you haven't done the work to build a really strong emotional connection with what you want, you will give up and then you'll not get it.
Yeah, love it. Absolutely beautifully said. Let's sort of dive into some specific commentary, if we can, around some of these aspects then, because I'd love to get your views on, because there's a, everywhere you look now, there's a investment expert or so-called trying to tell you what to do. And there's a lot of debates. You touched very briefly on the property versus shares exercise, and I'm with you. I'm an inclusive investor. It's not or it's and. But your thoughts on stock picking versus indices, for example?
Okay, so That's an interesting one, because indices and the ability to invest in an index has probably never been easier. One of the big growth areas, the biggest growth area, in fact, in financial markets over the last 7 or 8 years has been an area called exchange traded funds. Yeah. And what that can enable, and these can be a very, very useful tool for someone that's fairly new to this, because instead of looking at the screen and going, okay, do I buy BHP, or do I buy Commonwealth Bank, or do I buy Telstra, or what do I do? You could buy an exchange traded fund that invests in all of those companies. It gives you a level of diversification. It's a very passive way of investing, and it's been a huge growth area, particularly for people starting out, and particularly for micro investing, actually, where you're sort of saving those small amounts of money every transaction you do, and you want to put it in something. So there is definitely a role for that. The value add by trying to pick stocks is an interesting one, and I mentioned this in passing earlier, and it's good to return to. 67% of active fund managers underperform the index over a 5-year period. So nearly over 2/3 of them can't beat the index by picking stocks or trying to pick stocks. And again, I go back to, and if you're cynical listening to this, you'd be going, well, you've just been talking about trying to make better returns by buying stocks. No, I haven't. If you're trying to buy stocks to outperform the index, chances are you're going to be like most fund managers, unless you just happen to have a very, very strong natural talent. If you do that, send us your resume. You may have a very strong natural talent for doing this, which is great. We're not trying to pick stocks to outperform the index. What we're trying to do is generate cash flow from those stocks by that known event of time passing by to outperform the index. And in fact, cash flow on demand, the buy right index does outperform the all ordinaries over any given time frame. So buying specific stocks can be a little bit more challenging, but it can also be an awful lot more fun, because if you've got a particular view, and let's say you've got a predisposition that lithium, because of what's going on in the future, is the place for you, you could buy the lithium ETF, and I happen to be invested in that at the moment over in the US, or you could buy a lithium mining company that you perhaps know a little bit about. Maybe you're in the mining industry, you've heard a rumor, and you start to go on a more stock-specific journey. There's a potential for a much higher return if you get it right, but there's also inherently significantly more risk there as well, because maybe you're not right and you're not diversified. You've got all your eggs in one basket. So there's a really strong argument that investing in the index can sort of smooth that out. But it's a fairly dulled process. And rather than just pick stocks and then use a strategy like cash flow on demand, and you will get an outperformance. Don't just pick the stocks on their own.
Yeah, I love that. And something I know that my understanding, and correct me if I'm wrong here, that Australian investment education does is not only educate, but you've actually got a brokerage that actually assists your clients to be able to select stocks that suit them. Am I right in saying that, or?
That's exactly right, yeah. And we've got some technology there called Easy Trade. You just literally 3 clicks and your trade is done. It's a very, very powerful system that we've built. But again, the reason we provide that for our clients, it's a kind of serendipity. You can't, as a walk-up start, access our broking or Easy Trade service. You need to be a graduate of our education, because that's, as an advocate for financial literacy, as you are too, educating people on what they're doing with their money has never been more important. And fairly topical this week. If we look at APRA with the review of the MySuper, the legislation now is that if you are an underperforming super fund, you're obligated to write to your clients and say, we've done an appalling job. Do you still want to invest with us? Yeah. Which is huge.
It's great,
and it's something we've been requesting and lobbying and being part of for years, that there should be more disclosure in that space. And if people learn what they can do with their money, I'm pretty sure they can outperform some of the underperformers that are on there. And we're not talking a handful of funds. There's 13 funds they've named and shamed, but there's over 1 million Australians have had their money put to sleep. It's a disgrace. So get educated, get control, and see what you can do for yourself, because heck, you work hard for your money, get it working hard for you, and trust yourself over anybody else in that journey.
Absolutely agree. A couple of the sort of trendy exercises that come in and out of flavour, and they've been doing so for the last 10 years or so, is the crypto craze. What's your read on crypto generally, both now and in the future?
That's a very interesting one, isn't it? And it's funny that you can see on social media when crypto is doing well because all the ads and on all the posts pop up, and then when it's getting flayed, it all seems to evaporate just as quickly. And look, if you'd had this conversation with me probably 6 months ago, I'd say it's not something I've got any interest in. I dipped my toe into the crypto space a few months ago, actually at the request of my barista of all people. We were talking about it and he's going, "Are you in?" I'm not. And he said, "Well, why not?" And it was one of those things I actually found quite hard to actually say, these are the reasons why not. So I dipped a toe, had a bit of a play, went through a bit of volatility and the account was down a bit. Now it's up, but it's not really my flavor. I don't so much have a problem with crypto. I think where the challenge I see with it is the way that it's been marketed to the general public as this, here's the panacea for all of your financial woes. Put $1,000 in here and you'll be on a super yacht and driving a Lamborghini in 3 minutes if the adverts are to be believed. And that kind of thing is unconscionable, and it's allowed to happen in the crypto space because it's obviously unregulated. We work in a regulated environment with ASIC, the industry regulatory body, ensuring that that kind of predatory marketing isn't going on. The second part, as I say, so the actual approach to people to get them in, the solicitation of the client, I think has been very, very poor. Where I see the future for crypto is not so much actually in cryptocurrency, but in the underlying technology, the blockchain technology particularly. That's where I think we're going to see the biggest opportunities come out of this. It's been a maverick play. If you're someone that wants to operate outside of the system and I'm not complying with the government, I'm my own person and it's offshore and it's hidden and you don't have to disclose it, that's great. But the regulators tightening up on it every day, and you're seeing that around the world as different countries change their reporting around it. So at some point it will become regulated, and that'll pop that bubble for the mavericks that are out there, the counterculture folks. The real underlying value, I think, is the blockchain technology that's been developed. So far, it's not been hacked. And if you look at the application of that in more traditional business, whether that's in music to ensure that royalty fees go to the artist and avoiding plagiarism, in pharmaceuticals where you can see the development of drug lines over time to enhance them, particularly in the current environment. Even a company like Kodak, which was bankrupt, refused to embrace digital technology, even though it was the company that invented it, in case it sort of killed off its film business, went bankrupt. And yet now Kodak is at the vanguard of using blockchain to ensure that all of the billions of images that it have are correctly copyrighted and that royalty fees flow. So I think blockchain is actually where the real play is, and crypto is rather like the little bit of chrome that's shining on top of it that's attracting people in there to explore that.
Yeah, it's very well read. Given the circumstances we're in globally now and the amount of money that's sloshing around and the cheapness of money if you need to get it on credit, we were seeing some pretty crazy activity with the example early in the year of GameStop and the sort of Reddit herd trading phenomena. What's your read on that and the likely impact that it's having and may continue to have on markets, and what investors should be doing about that?
I think there was a great quote, and I think George Bush Jr. managed to balls it up when he did it. Fool me once, shame on me. Fool me twice, shame on you. Well, it's actually the other way around. That was the Bush quote. And in this instance, the GameStop folk, got one up on the hedge fund industry for sure, and no one's going to lose any sleep over that. Anyone that's watched the TV show Billions will probably feel much the same way. The reality is that happened, but markets, by their very definition, find their own level, and they are pure insofar as information flow will disseminate across a large number of people, leveling the playing field. So if you've got your GameStoppers on Reddit in some of these private forums trying to ramp stocks, just ask yourself a very simple question. Do you think your average hedge fund manager over in the US, sitting in his 20 billion assets under management business, hasn't seeded those forums with their own analysts, people that are gleaning that information and publishing their own stories now? Because you heard the story of GameStop. How many has it happened to since?
Yeah, that's exactly right. It's a very good call. Something that's interweaved amongst what we've talked about, and I'd like your thoughts on this. a lot of the conversations I have with investors, because they come in with a very clear exercise of investing in equities or investing in shares, and as you very well pointed out earlier, they're chasing the money. One of the big mistakes I see investors, and this is across the board, make, is they don't match the time they have available to the time that's required to manage a particular investment strategy. And I really see themselves trip themselves up constantly on that. What's your read and your view around the importance of matching your personal time to the time that a particular investment approach or style requires?
Yeah, that's a terrific point. And I'm not a lazy person by my disposition, but when it comes to investing, I think having that lazier, passive approach makes an awful lot of sense, because for your average person, if you're going to replace one job with another, say, well, I'm going to be a day trader, for example, don't do that. 97% of day traders lose money. The 2% of them manage to break even, and about 1% actually make a profit. So the odds are well tilted before you start. The hourly rate is appalling. The stress levels that go with it are dreadful. You're not going to look healthy because you'll be sitting indoors looking very pale, probably with a catheter fitted, so you don't need to go away to go to the bathroom. That is not living. That is not living at all. And it's not going to enhance your lifestyle. And so, that kind of hands-on kind of stuff is going to give you some excitement if that's what you're after. And again, that goes back to understand what your goal is. If you're after excitement, that'll give you excitement. You're not going to make any money, but it's going to give you excitement. Likewise, anything that sort of requires, more than say half an hour a day. And I'm pretty good at managing my time, as most people that are successful in business are. It's our most precious thing to manage. And if I had to carve out in my day with 5 children at 6 years old and under, managing a juggernaut business that operates across numerous countries around the world, and being able to go to the gym, be fit, have time for the relationship with my wife, maybe get out on the tractor and do some work on the farm, I simply wouldn't have the time to find more than about 30 minutes a day. And I use that as my benchmark to say, if you've got something that's going to require more than 30 minutes a day and it's new to you, the chances are you're not going to be successful at it, because going sight unseen, saying I need 2 hours of your time every day for the next 2 months, and I can't promise you're going to make any money, and I don't even know if you're going to be good at this, is a very, very big ask of people. If you ask for a minimum amount of time where they're able to start to see a return on that time dollar-wise and also in terms of their personal growth, they're likely to open the door to make more of that precious commodity that they have available to it. But you don't really want much that's going to, I wouldn't have thought anything more than about half an hour a day. It's just too intrusive.
Yeah, perfectly said. Absolutely perfectly said. Now, there's been a lot of talk, again, right across the board about asset bubbles and pending busts and bursts. What's your read on where that's at, and what should investors be doing in the short to medium term to protect themselves in the event that there are some corrections in the near future?
Now, I've been quite vocal on this through our social platforms, and my take, I guess, as an economist by qualification too, is that interest rates are far more likely to go up in the short term than your average person is going to believe. And I feel for your average investor and your average person on the street for this, because the Reserve Bank of Australia were most emphatic when they came out and said, we will not raise rates until 2024. So to all intents and purposes, anyone that's borrowing money has got the word of the Central Bank of Australia that they're not going to raise rates, so it's safe to gear up and borrow at least until 2024. And that was a very, very dangerous statement to make. Central banks cannot and should not make those kind of statements, because their interest rate policy is governed by what's going on with the economy, not any other agenda. And we're seeing now the ramifications of interest rates at historical low levels, 0.1%.
Yeah.
The world is awash with money. It's cheap to borrow. You want to borrow $1 million, it's going to cost you $30,000 a year, which is, the money is effectively free, for want of a better description.
Yep.
What we're starting to see is inflation really gain a toehold. And the headline figure officially in Australia is 3.8%. I think most people that order groceries each week from the supermarket or go and do their grocery shopping will know that groceries are getting a damn sight more expensive than 3.8% a year. Go buy your lamb cutlets, buy some steak, and see what you're paying for that kind of thing. Pretty good reason to be vegetarian at the minute. If you look at the cost of fuel, if you look at the cost of your private healthcare, which would have jumped by 8% over the first 6 months of this year alone, if you look at your electricity bill, given the fact that so many people now are spending more time at home than they have in the past, the cost of living has simply gone through the roof. And real inflation is probably closer to 6.5%. So the Reserve Bank have got a very difficult decision to make. And this underpins the performance across all asset classes. If they make a small correction to interest rates right now, there's a loss of face. They broke the 2024 promise, but it's going to take some of the heat out of the property market, which has to happen. I live in Byron Bay. The market's at 45% last year. It's insane. I just looked at a 640 square meter block of dirt with a 3-bedroom knockdown on it, and the agent wants $8 million for it. Things are insanely expensive and driving by that low cost of money. If there's a small move up, a quarter of a point, it's enough to just put a little bit of cool water in with the hot just to make it warm. It's not going to collapse the market, but it's going to take some of the speculative pressure out of it. If you don't make that move over the next, say, 2, 3, 4 months, inflation let's say in 6 months' time is going to be sitting at 5 or 6%. And moving interest rates by a quarter of a point is going to have no effect. You're going to have to move interest rates by 1.5%, 2.5%. You've been around long enough and seen so many cycles in the market, as I have, to know that a quarter point won't do anything. It's going to be a far harsher measure. And if that happens, the impact on property, on stocks, on everything is serious, and you are going to see a major pullback. So let's hope that they're prudent. And as Margaret Thatcher once said, you may not like the taste of the medicine, but it will save the patient. The sooner that medicine is dispatched to take out some of the speculative heat, I think we've got a more sustainable economy. Let it go, harsher measures will need to be taken, and it will have a much, much more marked impact on property for sure, but also stocks and also other asset classes that are out there too. Ultimately, people have got to be able to afford to live. There's no wage growth. If inflation keeps going up and property prices keep going up, rent can't keep going up to sustain those values. Things are overstretched. You will get a pullback. So I do hope that they put the ego aside and say, look, we shouldn't have said 2024. We've got to take some remedial action. We're going to move on rates now gently, just to take the heat out of the market.
Yeah, I'm sort of in two minds on that one. My own read, Andrew, is I think because in the old days the only blunt lever that central banks had were interest rates. What we've seen over the last 4 or 5 years with the much more active intervention of APRA and ASIC on the bank policy in particular is that macroprudential changes and putting the squeeze on the banks has had probably more impact than rates in real terms. So my current feeling, a little bit contrary to what you're thinking there, is that I think they're more likely to use those macroprudential measures in the short to medium term for two reasons. One, for the reasons you've just spoken about, its impact, and it could be a catastrophic one if there's a rapid raise in rates. But the fact is that the governments have also spent a lot of money at very low rates, and they have a similar obligation in terms of servicing that debt. It would be catastrophic to governments as well as you and I and every investor out there if they were to ratchet up rates too quickly. So I wonder whether it's going to be a short-term increase in rates or whether they're going to tighten the screws through those macroprudential alternatives. And we've got a finance broking business, so we're seeing firsthand that the banks are already starting to institute that through much more heavy imposition of things like debt-to-income ratios and other mechanisms that are starting to dampen the demand. Because that's what we need to do, is we need to take demand out of the equation. Given that we've got a sort of hyper demand that's been fueled by the massive amounts of stimulus money, the incentive programs, and the cheap rates that you've spoken about. So I think there's a number of ways it's going to go.
Those measures too. I think anything that you can do to keep things growing in a sustainable fashion has to be good, whether it's an increase in LVRs on investment properties, any of those measures that just take the speculative heat out of it and keeps the show on the road has to be good news.
I agree, but I think the important point underlying that whole discussion is that investors of any description need to be very mindful that we're at the bottom of the barrel right now, and that there's only one way that costs are going to go, and that is up. So whether it's now or at some point down the track, investors need to be taking that on board with their approach to investing. And what are some of the precautions and the risk protections that investors need to be positioning themselves with to avoid any of those storm clouds that might be on the horizon?
Yeah, I think getting your debt structured is a crucial one, certainly on the property side. For our guys that are more stock market focused, one of the things that we advocate using is the purchase of insurance for your shares. Now, that might sound a little bit out there too for a lot of people, and yes, you can do that. Again, we use options to assist us with this, and effectively what it will do is give you the ability to guarantee or fix what your downside risk could be. So, let's take Commonwealth Bank. Stock's trading at $110. You could have insured your shares for, say, $104 out till January, February next year. So, 6 months of insurance. It would have cost you a few dollars to do that. The Commonwealth Bank's now $100. By buying that insurance, you would have locked in the right anytime over the next 4 months, if you wanted to be able to sell your shares for $104, more than what they're worth right now. Well worth doing to eliminate that downside risk potential of a real sell-off in markets. And you can insure your shares at a level that would suit you. And again, it comes down to individual choice. If you liken it to, remember back in the day when you could go to the airport and you could hire a car, you walk into the Avis office and they've got your hire car ready and they say, okay, well, Mr. Martin, here are the keys for your car. Just one thing, the excess today is $750. Do you want to reduce that? And you go, yeah, look, if you're fairly, competent and you're driving and you're going out to Daylesford or something from Melbourne, you might say, no, I'm pretty happy with that. But, if your car's going to be left out on the street for 4 days in Braybrook and there's no garage and no street lights in the street that you're in, you're probably going to want to reduce that excess a little bit. And so, you've perceived a higher level of risk. So you reduce that excess down to, say, $250, or if you're super conservative, you can zero it out. You just got to pay more for it. And you can do exactly the same thing with your shares. You can insure them at a level that you choose. You're going to pay more if you're insuring them for a higher level, just like you would with a car. But it gives you that peace of mind. If you put your screen on in the morning and your shares have dropped 30%, it doesn't affect you because you're insured.
Love it. And it's it's sort of taking the sort of stop loss exercise or the guaranteed stop loss exercise to another level.
Absolutely, and that comes with huge peace of mind for people, especially if they're new to this.
Yeah, brilliant, and it's something that a lot of investors wouldn't even be aware of, Andrew, to even have the opportunity to access insurance to cover their equities. That's brilliant, mate. It's been a really good conversation. I'm really enjoying our chat. We've only really just scratched the surface, so I'm going to open the door to get you back on, get invested on a more regular basis to dig a little bit deeper on some of these areas. But really have whet our appetite. I want to sort of transition now into what I affectionately refer to as the ambush round, or the bushfire lightning round, where I ask just the fast 5 questions that listeners always want to glean your words of wisdom on. And
gee, you've been working me pretty hard already, so I'm definitely going to be working up a lather here.
This will be easy, mate, but I'm going to get you to tap dance to this one. So what's your favourite quote and why? You've mentioned some great ones already, but what's one that you haven't mentioned that would be relevant?
I'll give my father credit for this. I remember working on a building site with him in my summer holidays, father-son bonding time or slave labour, depending on your definition. He said, son, always remember this, measure twice, cut once, because when it's cut, it's done. And I've translated that across into my trading career, and it's exactly how I teach my clients to measure it twice, get it right before you hit the go button.
Love it. That's a cracker. Turning back to the literary field, apart from Robert Kiyosaki's Rich Dad, Poor Dad, what's another top book that you'd recommend the listeners have a read of, and why?
Look, I'm a voracious reader, as you know, and as I know you are too. And it's finding something that's of interest for you. I'm going to move that over one. Having read Rich Dad, Poor Dad, I then followed it up with cash flow quadrant, and that one for me, putting it together, I was already making good money as an employee, but it enabled me to make the shift from being an employee to self-employed to a business owner to ultimately now where I am as being an investor. And it was a very, very good nuts and bolts, easy to digest thing. And that might surprise people. You think just because someone is an expert in their field, I'm an expert at trading, that's what I do. But back in my early formative time, when I was working this out, I was good as an employee, as an investor, but I wasn't doing it for myself. And that provided me with the pathway to really starting to go, hey, forget about doing this for a living, do it to help other people, do it to help yourself, move into that pathway. Great book.
Yeah, it's a great book. It's just a brilliant framework that, again, I was like you, that was the next book I read after Rich Dad, Poor Dad, and it really allowed me to see where I was, but where I needed to be if I was really going to optimise both the financial position, but also the lifestyle.
Totally.
Which is key driver there. Now, it's spot on. This one's a little bit...
I love telling that story. I've had the privilege of speaking alongside Robert himself probably for about 14 or 15 years on and off. And I think he's got quite a healthy ego because he loves me telling that story. So.
I bet he does. No doubt about that. And I'd love to have a chat to you about your rubbing shoulders with Robert, because he'd be a pretty interesting character. He's got some pretty strong opinions on things, even in the current equation. He's got some pretty out there opinions. But I want to shift quite sideways to the area of tax, because a lot of Aussies believe they pay way too much tax. What's the top thing and top legal thing that you've done to minimise the tax that you pay, Andrew?
Look, I think the key thing is a fact of life. You've got to deal with it, and as you rightly say, get it done in the legal way. One of the things I think is most important for me was getting my structuring right. When people start on a journey in the investing space, they sort of kind of just want to get started. Maybe they start in their own name or not the right kind of entity. And then once I get good at this or make some money or do a few things and feel comfortable with it, then I'll get my structure sorted out. Get your structure sorted out first, because changing things halfway down the line is incredibly expensive. Take the time, get great professional advice, get the best advice you can afford, get your structuring right first and foremost, and everything else will then take care of itself.
Absolutely spot on. Yeah, absolutely spot on. Having a really good accountant on your team is an absolute must, because it will either cost you or save you thousands, depending on how you set it up, and also protect your position and minimise the risk if you've got the right structure in place as well. Okay, I want to sort of turn back to the investment advice piece for a minute and get you to share what's been both the worst and the best piece of investment advice that you've ever received today.
Okay, I think best and worst I could wrap up into the same piece of advice, and I think that was my parents. They always said, Andrew, save your money for a rainy day. Great advice in the UK because it does rain a lot, but the notion of saving, I think, is key. If you can't save, you're never going to be an investor. And we're in a society these days where people don't like saving. It's not exciting. And this is where some of those micro investing platforms have been great to kind of force people to save. And so learning that habit of saving has been great. But saving in cash at the moment, with interest rates where they're at, you're just effectively going backwards. Take out inflation, take out your tax, your money's worth less next year. So save your money for a rainy day, but make sure you invest it would be the twist on that, I suppose.
Yeah, brilliant. And you're absolutely right. We live in a world of instant everything. So people have got to have everything yesterday, and the whole concept of stacking money away is just almost foreign, unfortunately, to many Australians, and much to their detriment down the track. So brilliant thoughts around that. The final question then comes back to habits, or what I call rewarding rituals. What's a personal happy habit or daily discipline that you utilise that contributes most to your investment success today?
I think for me, I like structure, and I'm a voracious journaler and time manager. It's the thing I'm most guarded of is my time, because ultimately I'm never going to get it back. So I choose how I spend that time extremely carefully. Yet most people, it's the asset that they waste the most of, browsing, scrolling, watching some mindless drivel, whatever it may be. And look, if that's your goal in life, great stuff, follow your goal. But, if you want to get stuff done, whether that's in the investment space or probably even as a precursor to that, in the personal development space. Goals and personal development isn't about changing who you are. It's to enable you to become the person that's capable of getting what you want out of life. That's all. But it takes time to do that. So for me, investing my time and investing in the processes I use to help me manage my time every day, all day, is without question my best investment.
Yeah, love it. Absolutely love it. Brilliantly said. Sort of coming to the close, big question this one. It gives you a bit of an opportunity to sort of wrap up the key messages that you want to communicate. If I gave you a microphone that spoke to every single one of the 7.7 odd billion people that are currently alive in the world, and I gave you a minute to talk, what would you say?
Oh, gee, there's an expansive question, isn't it? I think having some level of clarity of what you want to be and not being constrained in that thinking. Work out what your goal is. Don't be constrained or blown off course by other people. Give away the good opinion of other people. Start yesterday and make sure what you start with is educating yourself, both in terms of the skill set to get what you want, but more importantly, in the daily habits and rituals and mindset that successful people have. That would probably be it in a nutshell. It's probably not taking me 60 seconds to get there. But work out what you want. Don't let anyone blow you off course, and take very, very deliberate actions to get there. Invest in yourself and start yesterday. Definitely start yesterday, or better yet, the day before.
Love it. Love it. And it's even better if it doesn't take 60 seconds, because I think the message is much sharper as a result. Mate,
I'm used to talking to my 5-year-old son. His attention span's about 20.
I reckon it's a good place to start, because I think most of us now who are embedded in the social media world only have an attention span of about 7 seconds these days. So you're right on the bullet there. Mate, really appreciated your input today. You've opened our eyes to a number of opportunities there, but particularly the cash flow on demand. I think that is something that is well worth investigating further. It's something that very few investors have got their head around, because creating an income stream in the current world is going to be crucial. I think, given that there's a lot of storm clouds and rocky waters ahead of us. So really appreciate your input on that. Would love to get you back to dive a little bit deeper on some of the subjects as we move forward. And as the economic times sort of unfold, would love to get your insights around that. So really appreciate your time on the show today.
Absolute pleasure, Bushy. I'm really humbled to be invited on, and love to share this message with people. So glad we could help, and look forward to doing more of the same in the future.
Terrific. Thanks, Andrew. Talk again soon. Cheers, mate.
Thank you.
To get a summary of all this investment gold in the show notes, just email me on hello@khgroup.com.au. That's HELLO@khgroup.com.au. Or check us out at www.bushymartin.com.au/Get Invested. I look forward to joining you next week for another episode of the Get Invested podcast. So thanks for listening, and as always, dream as if you'll live forever and live as if you'll die